Welcome back. So the equity market is having a steady morning, still about 40 points up on the Nifty. Let's find out what are the big headlines in the commodity space. Manisha is back with us. Manisha, so what's top of mind for you?
Well, I'm looking at the crude oil prices because there are just so many statements going on. By the way, the Chinese data, most of that has come into the markets has beat street expectations. It is better than and it is less slower in sense of pace when it comes to the markets there. And that clearly could be a supportive factor there. But what really has led to some profit taking in crude, and it fell nearly 2% in the overnight markets, has been that US has given Russia a 50-day deadline to agree to a ceasefire. Now, this is the markets were anticipating that you could be looking at sanctions, restrictions, some big bang announcement from US yesterday itself, but we did not see that coming. Now, this has been postponed, and US has warned Russia of further sanctions of up to 100%, but this is a warning. And knowing US, we've seen a lot of rhetoric go on and not so much on ground. So the markets do believe that this perhaps could be sorted or solved in some sense. Now, buyers for Russia are countries like China, India, and Turkey. And while US has said that the sanctions would not only be on Russia, but on the third party, that is on the buyer secondary market as well. And that is where the concern really comes in from. When you look at the month of June, the Russian oil exports have been at the tune of 9 million tons. Now, that is a big amount. Russia, I'll remember, is the second largest producer when it comes to OPEC and allies there. And even, and it's not just about US, European Union also has said that they could be announcing an 18th package of sanctions against Russia. This could come in as early as this week itself. Now, OPEC's spare capacity is something that we keep talking about, that there is going to be more surplus going forward. And that has been keeping the crude oil prices in check. But if there are 100% sanctions on Russia and an 18th package from European Union as well, then that spare capacity that we seem to be relying so strongly right now is not going to be sufficient to fill in a gap of 9 to 10 million barrels per day. Now, the US higher tariffs for partners also is a bit of a concern. You could be looking at economies not doing so well, demand growth not so strong, and that in turn also seems to be weighing on in sense of crude oil prices there. Now, this is what Goldman Sachs has come out with in sense of its targets for this year. They're anticipating $66 a barrel for the second half, and they expect the prices to continue to decline in 2026 as well. From 66 to 56 is what they believe could be an average in the next year. But starting 2027, they believe that the crude prices will be higher. Because of these lower prices, you wouldn't see investments. Demand is expected to be stronger. So this year and the next year, it is going to be between 50s, 60s, max 70 that you could be looking at in sense of crude prices. Lack of new OPEC projects, lack of investments in the space are supportive factors going forward. But that's only expected in 2027. In the meanwhile, the European Union also has intensified its conversations with other trading partners like Canada and Japan and are looking at a collated response to US tariffs there. And then the markets also are looking at loads of US data that is coming in today. You have the inflation numbers, CPI and PPI numbers, all of that in this week itself. And then it also is about the industrial production, manufacturing activity, retail sales. All of that US data comes in this week.
All right. Thanks very much, Manisha, for that.